All right, I'm going to start recording. It's Accounting 122. We are September 5th, 2022. This will be chapter 14. As you can see, this is Colorado Mountain College 38797. It's Labor Day, and I know we're missing class today, so I thought I'd put up a lecture on chapter 14 so that we get through it. And hopefully maybe I'll go over some of the problems too before we even get to class, and that way you can ask me questions when you get there, but you at least have an introduction. So I'm in my little office in Glenwood Springs. If you'd like to see me here in office hours, you're welcome to do that. This is where we trade. There's a number of screens here and a television set and a really slick and nifty, fast internet connection that's necessary for a trading platform, which maybe I'll show to you. But anyhow, I'm going to get right into it, so I won't bore you too much with what I'm up to. This is chapter 14, Managerial Accounting Concepts and Principles. Now in chapter 13, we went through some analysis that's going to help you with your stock project. Please, let's figure out a stock that you're interested in. And again, nothing's written in stone, but start following maybe a company and looking at what's going on with them. It's interesting. Interesting is not interesting, it's tragic. I just want to mention this, just from a mental health standpoint. One thing that happened over the weekend was that this young CFO, I say young, he was 52, but I believe he jumped from a building in New York City. A very tragic story. Bed Bath & Beyond having trouble with a turnaround effort in what we would call a big bath, trying to change the company from within. The chief financial officer killed himself. I don't know whether it was over this. I don't know whether he had some underlying mental illness that was bothering him. But again, another shout out to anyone who's having that sort of trouble, because I'm involved in that. I'm a mental illness myself and alcoholism, and I would hope that maybe you'd reach out and try and get some help in that regard. Nothing is that important. Certainly not money. And we're here to count things, and I don't. The value of it is not what's important. The value, as far as a moral value, is not what's important. But he seemed like a good man, and it's a terrible loss for a lot of people. So anyhow, that was that story. But Bed Bath & Beyond is a story in and of itself, and whether or not the company can survive in the retail sector. Many retailers are in that boat. I don't know whether if you decide to cover a retailer, it could be interesting just in that regard, because there's a lot of people that I know that feel that there's way too much retail out there, and there's not enough demand for all of the bricks and mortar retail there is out there. So, but certain companies will do well, and that's always been the case. After our analysis in 13, that gets you going on your project a little bit, we start talking about managerial accounting concepts and principles. And in this tape, maybe I'll run it like this, because you can see the notes down here, and they'll be on the tape. And plus, I can come in here and draw on this, which I like to do. That makes it fun. So And here we're going to explain the role of ethics. And this is always a great discussion for me. I hope I'm going to try not to be long-winded because I know your time is of essence for most of you. Accounting concepts and classifying costs, manufacturing activities and flow of manufacturing costs. We're beginning to get into costing. Describe trends, assess raw materials inventory management, and days sales and raw materials. That's the analytical. And the procedural, of course, prepare income statement and balance sheet for a manufacturer. So you may not run into a manufacturer, may not manufacture anything in your lifetime, but it's good to understand how they work anyway, and get what's going on there. So we study it. Role of ethics in managerial accounting. The roles and ethics. Managerial accounting provides financial information to an organization's managers. That's what it does. A separate, they make it into sort of a separate portion of accounting. Or put me up here so you can see the notes. Financial and non-financial information to an organization managers, employees in charge of a company division, the heads of marketing, all sorts of things like that. You know, whoever's in the separate silos. So what happens? You know, planning, control. Control meaning our process of monitoring and evaluating organizations' activities. That's control. And who does that? Well, you do if you're involved in this company, right? And here they are. Should we build a new factory? Should we develop new products? Should we expand into new markets? This is strategic management. We're setting you up for that you know, upper division idea that all of this points towards strategic management and making good decisions. So I'm going to turn that a little bit so you can see me. But this is what you'll see at the end of your career. Like, oh, all this stuff is coming together, and so it should make sense after a while that it's all just one. It's a dynamic set of principles, a dynamic set of coursework that gets you to a place where you're just better at doing what you do at your job. And you get into some ethics and things like that, and some grander sort of narratives and issues that might affect business. So develop new products. What should we do? What should we do with this company? And this is finance. Which project should we take? Accounting, of course, tells finance what to do. Really, it informs finance. It informs economics, the economics of managerial decision making. So who's the users? You know, creditors, outside company, internal users, executive committee inside the company. The purpose, you know, to help external users make investment, credit, and other decisions. Finding and control decisions, right? So, you know, a lot going on. Monetary, some non-monetary stuff like that. And then immediately, we talk about fraud and ethics. Over and over again. If you don't get a chance to take a fraud course, I urge you to look into people like the Heterodox Academy, where I just went into a really good. Let me go to my YouTube channel. I watched a great. I watched a bunch of stuff this weekend because I'm a nut. And I got to my logged in here. Yes. Here's my history. You can see how just weird I am. Jay Leno. Conversation. I thought there was ethics from academic DEI in business schools, social responsibility of business to increase its profit. You can see you can find this stuff. I was interested in Milton Friedman and social responsibility of businesses and sort of a critique of that. But there was something else I saw on. But anyway, Jonathan Haidt, John Haidt, he is right now at the Education and Career, New York Stern School of Business, co-founded Ethical Systems, a nonprofit collaboration dedicated to making academic research and ethics widely available to business. You can look up his work on that, but he wrote a book called The Happiness Hypothesis here, and which is fantastic. He wrote Moral Foundations Theory, The Reich's Mind, Why People Are Divided by Politics and Religion, which is a fabulous book, and Social Institutionalism. But his writing and thinking about morality and ethics is endless. So if you're looking to get some insight into why people do weird stuff and that area of study, that's your guy. He's one of them. That Heterodox Academy is a great place for that, to find papers and discussions on that, especially on YouTube. Fraud affects all businesses. It's costly. The Association of Certified Fraud Examiners, ACFE, maybe you'll work for them, estimates the average U.S. business loss is 5% of annual revenues. Wow, right? So when I stand up, I say kind of flippantly that there's fraud going on in Amazon and other firms. I mean it. I'm not just fooling around. And I reference this book that's right behind me. I reference this book, The End of Accounting. This is Baruch Lev and Feng Gu wrote this book about today's financial reports provide very small component of relevant information investors and lenders need to wisely put their money to high potential organizations. Inside, the authors share their radical findings from examining quarterly earnings conference calls and investor meetings in 4 major economic sectors, revealing that a company's worth lies in the strategic value-enhancing resources it holds rather than the traditional assets in corporate financial reports. Interesting. Interesting. I read that book and I had this inkling that things were not good because I don't come from the CPA side of this, but I was not somewhat shocked to find that someone in academia, particularly Dr. Lev and Dr. Gu, would get together and put a book together and say, hey, there's a problem here, and it's a big problem. An internal control system. Internal control system is procedures managers use to ensure reliable accounting, protect assets, uphold company policies, promote efficient operations. This is where I say to you as upcoming managers, which I assume you will all be managers, I say things like, how well you know your employees is how good your information is going to be. How good your people skills are, and I'm not one to parse IQ in a way where there's all these different IQ, emotional IQ, and this and that. You can learn tools to be a better manager and be a better person. Build character. I've been trying to do it for years with mixed results, but I tend to get on the ground and see people and try to make sure that the people that work for me are doing what they say they're doing. And that's going to be up to you. Institute of Management Accountants requires that management accountants be competent. How do you do that? It's completely subjective. Maintain confidentiality, act with integrity, and communicate information in a fair and credible manner. What does that mean? Does my wife know everything that goes on in my life? Yeah, pretty much. Does that mean I broke my confidentiality? No, she's my mentor. She's my I trust her, and you should have a mentor. I think, regardless of whether you're married to that mentor or it's just a close friend or, in my case, a sponsor. Um, so career paths, there's tons of them. Top level managers make great dough. Managerial accounting can be used in many careers. I think you start beginning to realize that. I hope it's a good career. Excuse me, I got a little scratchy throat, but still COVID free. Um, Entrepreneurs use cost budgets and financial statements. Decision makers for both for-profit and non-profit. There's no such thing as a non-profit. I'm sorry. It's just a government designation to avoid taxes. But why don't we say something like organizations that do something specific good for society, like hospitals and, name your NGO. Instead of saying nonprofit, because nonprofit just, it means that you're not trying to make money. And you are, if you're running, like in the recovery world where I hang out, we need to make money so that we can treat more people that can't pay. Does that make sense? So we need revenue streams that are robust in order that the in case Medicare and Medicaid collapses, which I think it will in the future, we have charitable money there, profit, and hopefully endowment meaning, money that's creating more money through yield that we can treat more people with. So I don't like that designation. You can argue with me. I think that's fine. And I still love you. Describe accounting concepts useful in classifying costs. Right, we have now we just did that. That was ethics. Ta-da! Again, we did it in the first half of the course. And if you're new to this book, we did a pretty robust deep dive into the fraud triangle and other things like that. But if you're curious about ethics and how that kind of stuff works, or want to just talk about it in your own vernacular, I'm happy to do that privately. Or if you're confronting an ethical dilemma or a moral dilemma, the difference between ethics and morality is right and wrong. And ethics are a code of conduct that are created by organizations to define exactly what's right and wrong. That's the best sort of definition I can give you of the difference between those. Morally, Cain slew Abel. It was just wrong. Murder's wrong. But ethically, is it okay to give gifts to Chinese officials when it's customary? Well, we don't give gifts. We don't. That looks like graft. But in that country, it may be different. And I'm not sure of the customs there, so don't quote me. Direct versus, now we get into costing, right? Describe accounting concepts useful in classifying costs. Accounting concepts useful. Direct costs are costs effectively traceable to a cost object. And here we're going to talk about bicycles. And indirect costs, of course, cannot be cost effectively traced to a cost object. So direct and indirect, and you can see the examples we've got here, tires, seats, handlebars, cables, bike maker, wages, right? Whoever these gentlemen are here, putting these bikes together. Accounting and administration, rent and salaries, light and heat, insurance. These are indirect costs, so they have to be spread out over everything. What kind of costs? Over all the bikes, or all the sales. So next, direct materials costs that are direct costs for direct materials that can be cost effectively traced through the manufacturing product to finished goods. Right, so those are direct materials: tires, seats, frames, pedals, brakes, cables. Always interesting stories. You know, should we make our own seats, or should we have them made? Which should we do? Should we buy the seats or not? That's a question when you're a manufacturer. You try and figure that out. Then we have direct labor. Direct labor costs of wages and salaries that are cost effectively traced through the manufacturing product to finished goods. Wages paid to the assembly workers would be that. Then next we have factory overhead, and factory overhead is all manufacturing costs that are not directly, let's see, here we go. I'll show you what they have to say. That are not direct materials or direct labor and cannot be cost effectively traced to finished goods. Maintenance workers, you know, this is me. When you get all done manufacturing bikes, maybe I'm the guy that comes in and sweeps up the floor, and you know, at the end of the day, and also screws, nuts, staples, you know, grease for the chains, for you know, things like that. They're indirect, and then factory utilities, the lights. So how are we going to do that? You know, how do we parse that overhead? And this is the question that we'll be involved with in the next few chapters. You know, how do we assign costs to different areas? Then we have this concept, and this is all definitional and you getting used to the vernacular of accounting, and in particular cost accounting. But we have these new words and we have to learn them, and it's a pain in the neck. But either way, they help us. You know, they help us to observe and account for these costs. And so we break them down, we classify them, and we're classifying them in this case into prime and conversion costs. Manufacturing costs are often combined as follows. We have direct material, direct labor, and factory overhead. And as you can see, direct material and direct labor go into the prime cost, and direct labor and factory overhead also go into the conversion costs of converting something into something else, making all these parts into a bicycle. So conversion costs are incurred in converting raw materials into finished goods, which includes both direct labor costs and factory overhead. Notice that direct labor are considered both prime costs and conversion costs. So here they are again. Product costs are those production costs necessary to create a product and consist of direct materials, direct labor, and factory overhead. Direct material, direct labor, factory overhead. Period costs are non-production costs linked to a time period, and that in that area you would get such things as selling expenses are costs to obtain orders to deliver finished goods to customers. G&A, we call G&A, general and administrative, are costs of staff support and administrative functions. Those are interesting too, right? So selling G&A, selling and G&A, you'll see them put together quite often in the vernacular of costing. So there's that. Now we have this distinction between product and period costs that they want to nail home for you. So that'll be a question on your homework. One of the first questions, I believe, is on that, having you classified costs between product and period. And this is something as you sit down with your colleagues in the executive suite, or you know, just your little business. If it's me and Kelly, you know, figure out what's a product cost and what's a period cost. Well, direct costs in this case for bicycles, tires, seats, handlebars, all that. Period costs, um, indirect. So you have direct costs and indirect costs within these product and period costs. We're just trying to classify stuff into a rubric. So don't get, I know it seems like a lot of information, but it just trying to get you to, if you're a good cost manager, you need a methodology to drill into costs. And this is one way to do it. And you're going to customize it to your own business. Kelly and I will customize it to her business in the way that she wants the information, because she's the consumer of the information, right? So in this case, tires, seats, frames, chains, direct, indirect, accounting, rent, salaries for managers, light and heat, insurance, period costs, selling expenses like advertising, right? You get um, promotional materials, salesperson salaries, and all that kind of stuff, commissions, general and administrative, office accounting, office employee wages, office rent, right? All those, that office cost is a G&A period cost, right? So in the product cost, we've got direct and indirect. In the period cost, we have selling and G&A. There's your introduction to costs, and you can see how they play out. This is a cool little graphic on how they might play out in that regard. Year 2021 costs, you break it down into period and product. And then in product costs, we have inventory sold in 21, inventory not sold. The inventory not sold ends up being inventory that sits on the balance sheet. So it's an asset that's sitting on the balance sheet. Inventory sold in 2022 ends up on year 22 income statement. Inventory sold in 2021 on the 2021 P&L income statement. Right? So all these period costs and expenses, selling and G&A and general administrative go on that income statement. Right? So here they are. Period costs go directly to current income statement as expenses. They are not reported as assets, of course not. Right? That would you're far enough along in the course, hopefully, that you can delineate between assets and expenses. Cost concepts for service companies. The cost concepts described are generally applicable to service organizations. And right here we are, just to make sure we're recording. I'm looking over at my counter. Cost concepts describe service companies can classify costs as direct materials, direct labor, overhead, selling, G&A. Just a little different. I understand the nuance of inventory, right? So income statement and balance sheet for a manufacturer looks something like this. Reporting inventory on the balance sheet ends up looking like this. Raw materials, work in process, and finished goods inventory. They're explained down below. But for us, materials waiting to be processed. So if you're building sneakers, it might be rubber in a pile, the size of a mountain of rubber outside in the yard. And then it's got to be worked. It's got to be converted. So what happens? Well, we have a work in process, partially complete products. Some material, labor, and or overhead have been added. And then finally, finished goods. They're ready for sale. They're in the warehouse. So let's look at these three different balance sheets and get a little explanation on them. And I'll make them bigger here so you can see them, right? The primary difference is inventory. Northeast Air, of course, is a service company. So current assets section, they've got cash and accounts receivable. They've got some supplies and some insurance, but whatever. Telemart, of course, they have a merchandise inventory of what? That's a merchandising company. What do they have on whatever's on the shelves? And then a manufacturing company, of course, Rocky Mountain Bikes. We've got raw materials, we've got work in process, and we have finished goods. We have those three active sections of inventory. So this just wants to break this down and show it to you in living color, so that you get the idea between the differences between the types of companies, so you can get your head around that. Income statement, a little bit different, and we can look here, reporting costs in the income statement. We've got beginning merchandise inventory plus cost of merchandise purchased minus ending merchandise inventory equals COGS. That's a merchandiser, right? And in the manufacturer, this nuanced kind of difference is beginning finished goods inventory plus cost of goods manufactured minus ending finished goods inventory equals COGS, right? So that's the difference between, Target and a bicycle company that's building bicycles. So, and again, here they are. Here's these three income statements. Northeast Air is revenues. There's the expenses, net income. Telemart, we've got sales, and then we have COGS, beginning inventory, whatever we purchased, available for sale, less the ending inventory gives us the COGS. Then we have gross profit, selling and G&A, and finally we get to our net income. Rocky Mountain Bikes, in the COGS section, has this 11,200 cost of good for finished goods inventory of the beginning, and then cost of goods sold cost of goods manufactured. I'm sorry, and then goods available for sale. Then we subtract out the ending inventory, and we end up with COGS and gross profit minus selling and G&A, our expenses, and we get to our net income. So, again, just a shout out to the differences between these different statements, so that you might get a better idea of what they are, what the differences are. All right, manufacturing activities and costs, and the flow of manufacturing costs. This is very interesting. You start to, for me, I start visualizing myself. I've been on a number of factory floors. I've worked at a factory, which really opened my eyes to how things work. I did some temp work after I was done farming. I had this moment of, gee, I can do anything I want. So I went to work for we were manufacturing wheelchairs in Boulder, Colorado. And I was on the factory floor with a bunch of people. I just wanted to see how things flowed and how it worked and all that kind of stuff. And for me, it was good work. It kept me busy, my hands busy, and I was good at it, but I got a real glimpse as to what how manufacturing works, and just-in-time manufacturing, as a matter of fact. So, flow of manufacturing activities. We've got materials. We've got raw materials. We've got production activity, work in process, and we have sales activity for finished goods. So raw materials inventory beginning, and somebody's doing the purchasing of raw materials. All right. And then we have this work in process inventory, direct materials used, direct labor used, factory overhead used. These all have raw materials inventory, ending work in process, and finished goods inventory ending go on the balance sheet. Right? These are assets. We own that stuff. If it's rubber or shoelaces or parts of bikes or whatever, what have you, if someone came in, it's sort of like when General Motors went out of business the last time. Everybody's like, oh, everybody will lose their jobs. No, somebody will come and buy that stuff, and they'll start making cars with it. you know, and maybe it would be Tesla, you know, be a bigger operation or something like that. We're ignoring the fact that businesses are dynamic, and when one business losses are part of capitalism, and companies that go out of business are a good thing because they're not efficient. So when they go out of business, someone else comes in and they buy up the assets off of the balance sheet, and they end up using those assets to start another business. Materials activity and production and sales activity is all here. This shows a flow of these, which is kind of nice. So it's a good graphic of that will help your head work on this. Prepare a schedule of cost of goods manufactured, and explain its purpose and links to financial statements. Okay, so let's get the basics of this. Here's the equation you're going to need when you get into the homework and that. Schedule of goods manufactured summarizes the types and amounts of costs incurred in a company's manufacturing process. So we have direct materials, direct labor, factory overhead, total manufacturing gives us the total manufacturing costs, and then we add to that the beginning work in process minus the ending work in process to get the cost of goods manufactured. That would be a good thing to have. This in the vernacular of the book, the managers. Those managers aim to make better decisions about materials, labor, and overhead. We're just trying to lower costs in our manufacturing process. So we need a methodology to get a handle on those costs. And that's, you know, if you're good at this, I promise you'll get paid. If you're able to dig down into this better than other people, you'll get paid. Manufacturing statement here, it looks like this, and you notice we have these 4 sections: 1, 2, 3, and 4. Direct materials, direct labor, factory overhead, and the total manufacturing costs. Here they are numerically in the notes from the book. Compute these direct materials used, and then direct labor used, and everything should come together here to get us a total cost of goods manufactured for the year ended December 31st, if you will. I can make that bigger just to get a handle. See, we had this raw materials inventory, purchases, available for use, and there was our ending inventory. So we used $85,000 worth, and then in our direct labor was $60,000. Direct labor, remember, direct labor went to manufacturing the bikes. Factory overhead here. How do we allocate that? Well, we're going to learn about that later. And then we had these total costs. So clear as mud. And here's a good. These are the key calculations in a schedule of cost of goods manufactured. Direct material, direct labor used, and factory overhead. Cost of goods manufactured equals total manufacturing costs plus beginning work in process minus ending work in process. And then a little discussion here about estimating cost per unit. Manager uses scheduled COGS manufactured, cost of goods manufactured, to estimate per unit cost. Because would that be useful? Yeah. If you say, well, you know, one bike is costing me X amount of dollars. Oh, why would I care? Oh, maybe I'm comparing it to last year, right? I have some kind of comps that I'm looking at to look at performance and look at that area of manufacturing. You know, those employees, and looking at performance and saying, well, could we do better here? What's going on? Here's how it moves across these accounting reports. Let's take a bigger look at it. So in the schedule of cost of goods manufactured, we've got direct materials, direct labor, factory overhead, and then work in process, and work in process ending to get us the total. We got like Bronco colors here. Total of goods manufactured. I screwed that up. Slide. Total goods manufactured, and that goes to the income statement. Cost of good manufactured for year end there. Okay, so that 170 ends up going into here, and then finished goods ending, it was 10.3, so we subtract that out to get 171,400. Our net income 46,000. Right. So, and then look at the balance sheet here. We have that work in process inventory that came from over here. The schedule of cost of goods manufactured. We had 7,500 work in process. So those, when you stop the music on the assembly line, let's just say you've got this assembly line of people building bikes on a Friday the 31st of December or Wednesday the 31st of December, you decide you're going to close your accounting on that day. That's the end of your fiscal year or the end of the real year, and you stop that day and you perform what we call, right, the accounting cycle on that day. Well, if the balance sheet is a snapshot of what happened, then we have these bikes that are partially finished. Well, what are they worth? What's the value of those what if you were building jetliners? What's the value of a half-finished jetliner? Oh, we've got to try and make some kind of estimate in order that we have assets on our balance sheet that makes sense. So we have this work in process inventory that we're estimating, and we go, all right, it's $7,500. I'm going to put it on the balance sheet. That's what it is, and it's some function of how much labor is mixed with the raw materials that we took in and are starting to convert into bicycles. I hope that makes reasonable sense. It always sounds good in my head. The cost information is used on financial statements. There's a little explanation of that slide. That may be helpful. So that's what we've got, and I'll go over some of the, I think I have plenty of time. We'll go over a little of the, I'm 42 minutes in, I don't want to make this too long. We'll go over some of the problems just to get you ahead of the curve here. But let's describe some of the trends. We've got about 10 more slides here in managerial accounting. I think it's interesting. I think this edition is not the COVID edition. So it's interesting to look at because I'm going to critique some things. Lean practices, value chain, service economy, e-commerce. These are all sort of buzzwords that go into this. Digital, goes into these ideas behind managerial accounting. Machines, computers, human control to manufacture products. Manager and employer must understand the changing needs and wants of customers to align management with operations. Global economy, I always thought this was trouble, right? We're still have a chip shortage. The government is trying to step in and help, for better or for worse. The government usually, the way I think, steps into things that are already being fixed in order to, for political gain. But you can argue with me about that if you want. You think government is good, that's fine. I disagree. The lean principles. Many companies adopted lean business model whose goal is to eliminate waste while satisfying the customer. Just in time is part of lean principles. This is always paired with continuous improvement, Six Sigma, these kinds of programs. So where do they fit? It's just giving you a slide that says, hey, by the way, in accounting, we're very focused on strategic management, once again, and I keep saying that over and over. But there it is in a slide. and all of what you do in this, if you end up on the financial side of things, is, I believe, and maybe I'm biased. Well, I am biased. I'm always biased, but I believe that accountants make better managers in a lot of ways if they have the whole practice, the whole picture in mind. It's very hard to be a good manager without it, I think. Um, so what are lean principles? The goal of a lean business model is to eliminate waste while satisfying the customer. Um, Continuous improvement, rejects good enough. You'll see stories about Toyota and other companies that sort of started this total quality management and just-in-time manufacturing. I think that during COVID, we found out, a lot of manufacturers found out that just-in-time is not a good idea, and that maybe they should build a, a facility and store enough, let's say, chips to build enough cars so that they can keep their inventory up and not miss sales because they lack inventory. The other principle, lean principles, sort of moves away from what you're going to find out about later in strategic management, which is vertical integration. When Henry Ford began building Ford Model A's, he built everything. Every piece on that car was manufactured in Detroit. Now, car companies are basically assembly plants that take parts from other companies and put them together. They have subcontractors and this and that. I think after COVID and supply chain disruptions, a lot of companies are reevaluating that paradigm. I think that that's true. Then TQM, I was involved in TQM on that factory floor I worked on. Quality improvement applied to its business activities, seek and uncover waste, constant focus on high standards. And again, it's one of those things. Are you doing it? Are we focused on it? It's really hard to get employees buy-in on a lot of these things, and they sound great in business schools, and they sound wonderful in textbooks. But are you doing it? That's what I care about. Are you going down to the factory floor and saying, hey, are we paying attention to this TQM? How do you guys? I mean, I don't know what your method is. You take people out for beers or whatever you got to do to find out what's really happening. And I think that's a sign of a good manager and a good accountant for sure, is to find out what's really happening on the factory floor. And I've said this several times. JIT, very popular, not so much anymore. Maybe that's changing. It could be, but my analysis is anecdotal. I don't have any empirical evidence just yet, except what I see as far as problems with supply chains. So just in time means we've received customer orders, we've scheduled production, received materials in that area. Wow, something just went down. Okay, I'll buy that. Okay. So, interesting. My little light went out. Receive materials just in time for production, and then you complete the products just in time to ship to customers. I think what we saw during COVID was that once things started to break down, they broke down really hard, and this JIT. So the other, you're understanding, the other alternative is you have a warehouse filled with this raw materials inventory so that you don't run out and you can fill your orders and you can get stuff on the shelves at Kroger or the sports shop or wherever, wherever your manufacturer is heading. You're not dependent on a another manufacturer who's manufacturing a part that you need right now, because they call you up and say, well, we're not shipping anything because we don't have any employees, and we don't have any truck drivers, and we don't have any, right, XYZ. I think that there was a massive reevaluation of that. And again, I haven't seen the studies come through empirically, but I think they're going to, and that's my opinion thus far. So demand pull system is a very Keynesian idea. If you're an economics professor like I am, and you're saying, nah, you don't want a value, you don't want a demand pull situation. You want to have a supply situation. So then we talk about this esoteric thing called a value chain, a series of principles that add value to a company, products or services. They can use lean principles to increase efficiency and profits. To me, it's just like, am I examining whether or not things are efficient, and are you doing it? Are you being a manager? CSR, corporations must consider demands of employees, suppliers, and society. No, they don't. That's just not true. This is a debate, and it should be a robust debate. I just had a debate with some administrators about this CSR thing that's rampant, and it's only here in the in certain companies and other places. People have responsibilities. Corporations do not. If you're interested in this subject, again, please take a look at some of these things that I, in defense of the truth, the purpose of a corporation, right? Self-interest and the profit motive. Social responsibility of a business is to increase its profits. So the main analysis of this, and I'll give it to you in 2 seconds, so that you don't think that I don't care about the planet, or you make some accusation that I don't like my employees or something like that. You're wrong. I love my employees, and I am an environmentalist who loves the planet. But the problem with this idea of corporate social responsibilities is that it involves stealing. And how it does that is when you put your social responsibility as a corporate executive. Let's say you work for Ben and Jerry's, and you decide that your big thing is, for example, pollution. And you decide that not just pollution, it's chlorine pollution that's the worst thing on the planet. So you take money from the corporation and you decide to spend it on cleaning up chlorine pollution, if that were a thing. Now, I own a share of stock in your company. I do not think that chlorine pollution is a problem, because it's not. And so I think that you're taking money from my dividends to do something that you want to do. That is, in effect, taking money from the shareholders that is theirs. It's not yours. You are an agent of the stockholders, an agent of the stockholders. So in that way, a corporation does not have responsibilities. People do. Now, the other thing is that corporations must act within the law. So they can't just dump crap into rivers or do other awful things and treat their employees like there's laws. There's civil laws that take care of these things, and there's ethical boundaries that we find in society. So when I had this argument with administrators the other day, they said, well, CSR, the triple bottom line, ESG, all these buzzwords, and they're always acronyms. And they say, well, all these things are very essential. And I say to them, Yes, they may be good ideas. Yes, people may focus on them, but you still haven't solved the problem of taking money from one set of people and giving it to another, and that is theft. So when you take my dividends and you spend them on your pet social project, like the bike path or the whatever charitable thing that you want to do, you're taking dividends from me. And I want that money so that I can pay that, so that I can go and do my charitable giving, which might involve Catholic charities or giving to my neighbor or this or that. So you've robbed me of my charitable giving and you've prioritized yours over mine. That's the dilemma. That's the debate. That's the argument. We can have that debate in class if you'd like, uh, which is kind of fun. It's a great debate to have because this is rampant in the academy and in universities and colleges. Um, Goes beyond law, triple bottom line, financial, social, and environmental measures. Social environmental measures are unmeasurable. They're subjective. So it's very difficult to do anything with that. I don't think climate change is going to be a problem. I cite Steve Koonin. I cite Bjorn Lomborg. I cite all these different scientists that say climate change isn't going to be a problem. And you can't just come in and say, "Oh, you're wrong. You're a denier," or invoke some guy like I'm an idiot, because I've done the reading. So we disagree, and we respectfully disagree. I don't not like you because you disagree with me. I love you. But the triple bottom line impacts how business reports. Um, what I can say is, very importantly, this seems to be a trend. So you've got to pay attention to it. Maybe you'll make a career trying to create some metric that works for this. I will, unless someone gives me evidence that there's something measurable here, I will continue to, since 1970, I've been studying this. I will continue to say, I don't think there's something you can measure here. So I don't think it's an important metric. But here we are. So interesting. I thought you'd love that. My take on that. Assess, and finally, we get to assessing raw materials inventory management using turnover rates, days sales, and raw material inventory. Similar to, a merchandising company, you take raw materials used and you average them out, and then divide it out and end up with a raw materials turnover. Are you moving stuff out the door? Are you manufacturing well, efficiently? That's the question. And then, of course, days sales, 365, not 360. Banking is 360. 365 is for all of our ratios. So that is chapter 14 in a nutshell. I hope you liked it. Any questions? We'll go over it again in class very quickly, and maybe start on 15. But just to let you know, or help you out a little bit, why don't I go over to my Connect here? Here it is, and I'll go home. This is what my page looks like. I gotta log back in, and I'll go over a couple problems that they have. Here we are, 22 fall, that's us. And I'll jump into the homework and do a few problems. I'm just about an hour in. Maybe I'll go another 15 minutes or so, and then I'll post this so that you can see it tonight. It's 1:30 in the afternoon now. Chapter 14, homework. As you can see, we've got 2 students in progress, 3 students have submitted. Hooray. Those are our overachievers. If you're behind a little bit, don't worry. So now I've got, what do I got here? Listed are the costs associated with the production of 100 drum sets by Truby. We have plastic and wages and property taxes and all this. So they're just trying to get you to separate them out by product and period. The plastic for casing is a product. Office for accounting salaries, period. Right, that rent. All those things. Should be pretty simple, I hope. No further explanation. Only got 8 questions here. Pretty easy. I shouldn't say easy, because then somebody will call me up and say, no, it isn't easy. But again, product and period, trying to get you to, classify costs. Your ability to make classifications and do this is really going to be. I think I told you about my Jimmy's ex-father-in-law, who just made his name going to these Kellogg's factories and figuring out what was wrong in the costing area. I think you can make a great living doing that. So here we go. Year-end information, adjusted trial balance, and other records of Leon. So Leon, identify each cost as either product cost or period cost. Classify direct material, direct labor, or factory overhead. And here's how it played out. I can do this and drag this down and show it to you. Right, there's what they were. And here's how it type. It's not a product cost, is an advertising expense. It's a selling expense. Depreciation, not a product cost, right? That's my truck rotting out there. General and G&A. That's G&A is depreciation. Selling expense, not a product cost. So hopefully those weren't too bad. They're just a little tedious, if you will. Now we get this adjusted trial balance for Leon again, and then some additional information. So we got this adjusted trial balance, and then we have this additional information. Oops, let go. Right, that we've got. I'm gonna put it down here. I was hoping I'd put it down here. Let me see if I can make this seeable a little bit. Not really. It doesn't work that great. If I can make that smaller, it would be really cool. But I could put it over on the other screen. That wouldn't help you, because I can only get one screen. I use this software called OBS, and hopefully it's working right now. But it's a free software that I record on YouTube with. So we'll see how it goes. I just did an update on it. So we've got all this information. Prepare a schedule of costs of goods manufactured for the current year. How do we get that? Oops, come on down. Here's the selling expenses and the G&A. But here's one schedule of costs. So we had raw material inventory beginning, purchases, and then that's what's available for use. 1,091,000 with my numbers, 850. And then raw materials inventory, ending inventory there. So we know what we used. And then we have the labor that goes with it. Then we have direct labor. Then we have all this indirect labor. That's us accountants and the office people and all that. So we end up with a cost of goods manufactured down here after all these factory overhead and total manufacturing costs, add work in process inventory at the beginning, right? So there we go. Remember, this is just a schedule of cost of goods manufactured. And then we have an income statement to go with it. Right, and here's what it looks like. Sales were $4,000,004. We took the $1,966,000, right? 939. 1,966. Oh, 935,650, right? And that less that finished goods inventory gives us this number. Okay, and here's the explanation giving you these selling and G&A expenses, which should be fairly reasonable to get to if you look back here and scroll up and down and mess around with it. That's number 4. Number 5, here we go. Financial data for a merchandising company and a manufacturing company. Music World and Waveboard. They're making waveboards, I guess. And here we go. So you take that information. Merchandising beginning 135, 220 gives you 355 minus the 170, so 185 cost of goods sold. For manufacturing, of course, a little bit different, 220, 574. Right? It's just a formatting and cost of goods manufactured. Hopefully that was pretty simple. Number 6, same thing. There's my numbers, and just to really teach you the difference, the nuance between the two. And then we have a manufacturing company that reports the following information. We're going to do some analysis here, just like you would do. And here's compute raw materials inventory turnover, and then is the current year change favorable? Well, it's unfavorable, right? You went from 14 to 12. That means you turned it more a year ago than you turned it now. And then days sales and inventory 27.6. And here's the math down here if you're curious, and if you didn't really understand the math. You can go back to the slides if you want and look at those. Look at those. Right there is a days sales and inventory, and there's the inventory turnover, in case you forgot. But that's how they play out here in the math and the homework. And finally, number 8, same idea. We're going to do the same thing again. Looking good. Hopefully 12, 13 still current year and not as good as last year, so unfavorable. And then 28.6. There's the math. So that should put chapter 14 in the can, and maybe we can get to chapter 15 next Monday. Please reach out if you're having trouble, and you need, or you want to call or see me or Zoom or whatever. As you can see, I've got a little studio here, so I can always throw up a YouTube pretty quick, and hopefully this one went well. So anyhow, enjoy the day and the holiday weekend, and it was nice to have a day off for me. I know that the markets were closed today. This is fun for me, believe it or not. And but anyway, it's 1:45, and I'm gonna pack it up here and go home and relax. That's what I'm gonna do. So anyhow, thanks so much for taking a look at this, and we will talk next Monday. And I'm gonna stop.